Why am I not taking these 50% gains in Tesla and ARK funds? Let's see, 50% in ARK, 53% in Tesla, 66% in Hybel. Why am I not taking these gains? 43% in yen. Okay, there's a good reason. I have a very specific reason for not taking these profits, even though you would think 50% gain, you have to take that. But no, EDF 50%. Why would I not take this profit? Here's the reason. Because I'm going to lose the income. If I lose the income, EDF's paying me 20%. Now the yield's only about 13%. Probably. Let's check it out. I bought it down at 20%. I locked in that yield. Look at this run it's had up from the lows. The yield is now 13%, as I said. That was just a guess. But I bought it down here when the yield was around 20%. So I don't want to lose that yield, one. But two, I don't want to lose the income, So $10,000 is paying me, on 20%, that's $2,000 a year. So that's almost a couple $100 a month, sort of. You can do the math yourself, but I don't want to lose that. If you do EDF and you combine all these little $10,000 funds with, a couple of $100 a month, it adds up, believe me. But the real money comes from these, which we've discussed in other videos. Okay, these make about $10,000 a month. I mean, these between the two C's right here, that's $5,000 alone between those two. So, okay. But why don't I want to take these profits and these options below? That's why they look different than these holdings. These are the options when you see these strike prices underneath. Well, because look at the premium I received. Look at Tesla. I'm up 53% in Tesla, but I received $800 for the premium. So I have 50% more to go before I get that full premium. And some people may say, well, you're being greedy. Again, you need to take that profit and run 50%. Well, here's the other reason why I don't want to do it. Because I'm going to lose valuable exposure to the theme. And the theme, these little gains each day, these are what help me outperform in the market. So these days gains, I get them because I have very passive names here that aren't designed to move very much. You see a lot of them are flat, zero. Well, the market's pulled back. We were up 4,000 before in the day, and now look at the market up top. It's Dow's 0.2, S&P is 0.7. So we're pulling back a little bit, but I think these gains are going to hold. See, we're already up 2,500. Just a second ago, we're up 2,000. Now it's 25. Anyway, but because these are designed to go slowly, and they generally move very conservatively, these upper income funds up here up top in my portfolio. That's why I have so much money in them. They pay me big dividends, 10 to 20% each, and they move slowly. So how am I going to get the performance? Well, I need these options to help juice the performance of my portfolio on a daily basis. So Hybel up $150. Hybel is the S&P high beta ETF. So that's going to give me S&P exposure, but much more volatile. And then the put option makes it, when I sell it this far out of the money, it makes it much more conservative too. So they balance each other out. The high beta nature of Hybel, which is also a triple, and it's the S&P high beta ETF, which means it's very aggressive, combined with the fact that it's the strike price is very conservative, makes it actually move conservatively in a day to where it's just a normal beta. It turns into a normal beta for an S&P fund, and I'm only using 30, which is times 100, $3,000 to control 3,000 of my equity to get this exposure. And I haven't spent any money. They paid me almost $900 to use my 3,000 in equity because I sold the option, and it in return reduces my margin interest. Okay, so if you add up all these premiums that I received here, it's about 30 to 40,000. So that's what knocked down my margin from 250 or 260 to 230. So these premiums are are helping me lower my margin interest, in addition to getting valuable exposure to the theme of, let's say, a Tesla, and you don't get FOMO as well. That's another reason we could list, is just purely not to have FOMO. That sometimes that hurts more than actually making the money. Tesla, for example, I know it's going crazy today, and I'm only up 75, but I made 800 in it, and I can't have the entire world. Look at all these funds I have. I have Bitcoin, all these things, and I don't even own them. My real money is coming from up top up here, which, as you can see, like days gained, 1,600, 500. So these are how I'm making, big money anyway, in a conservative way. And then I just use these options to juice the performance a little bit while getting paid these exorbitant premiums to then knock down my margin, because, since interest rates are going up, we don't want to pay that interest. So we have to find clever ways to knock down the interest. So we knock down the margin, and we do it in a way that doesn't suck up the equity. We always keep the equity over 100. And we do that by finding low maintenance names, or only using a small amount in each. Like Tesla is a low maintenance name, so I didn't mind doing 5,000 in it, because it's a 30% maintenance name. But Highbull is 100% maintenance, so we only did $30. So but you also receive the cash for Highbull, which is $900. So really $2,000 is taken from your equity, and it's not a big deal. And you've actually gotten paid to lower your interest, your margin interest here. I know this is all probably sounding confusing, but look at all the cool numbers, all right? This is a lot of money, all right? 30 to 40 grand in premiums. Just for clicking my mouse, I get 30 to 40 grand. And they're very simple, and they actually they lower your cost basis, and they're a much more conservative way to get into a stock. I don't know why people play stocks outright. And then all these other funds just pay my dividends, which are, as we always have to list in each video, about $95,000 a year. So, and they're paid monthly, by the way, $95,000 a year, paid monthly. All these are paid monthly. I do not want to lose this valuable income. But there's a cost for buying these passive income names. They go a little slower than the market at times. And that's why you have to juice the performance with some of these options that you don't have to buy and take risk outright on. You can sell, and they're much more conservative. And then they lower your margin interest, and then you don't have to pay taxes. These are why, if you are up, by the way, the reason why I'm not selling is I don't have to pay taxes if I sell. There are many reasons why not to sell these things. I'll list them one more time. Okay, even though they're up huge. You don't want to lose the income, or the premiums that we received. We're only halfway there. 50%, we can get twice that. And I do think Tesla will settle above 50 by this date, and we will get this whole entire premium, because that's the condition. It has to settle above 50 by this date to get this premium. And even if it doesn't and it's settled below it, we're happy getting put to the stock at that price. It's like a great entry price to get in and control that exposure in our portfolio too, so it can help those passive income names up top perform better. So even if we get assigned, it's a good thing. We want to get assigned. You have to sell options on things you want to get assigned on. So again, these are the 5 reasons. 1, you don't want to lose the income or the premium. 2, you don't want to lose the valuable exposure to the theme. Okay, I don't want even EDF. I don't want to lose emerging market bonds. That's a valuable theme. It's bonds that's been beaten down in 2022. You want to have that. You always want to have that, especially now though. And it's emerging market bonds. It adds diversification to my local bonds, which are GOF and RIV. So don't want to lose the valuable exposure to the theme. 3, there's more money yet to be made in these, including the dividends, monthly dividends, and in these premiums. There's more money to be made. 4, I don't want tax implications. I don't want to have to pay taxes unnecessarily if I don't have to. And 5, and most importantly, well, not most importantly, but really in any order, it knocks down my margin, which knocks down my margin interest. And then I use that money to then invest in passive income names elsewhere and make more monthly dividends. So, okay, these are why I'm not selling, all right? I hope you enjoy this video. Yes, we're up 50%, but you have to think. You have to not take the quick buck and stroke the ego What are you going to do with that cash? You sell, what are you going to do with it? You know, cash is getting nothing. It's losing to inflation. So you have to stay invested, and you have to keep your performance going in your portfolio to help your passive income names. And why not have more performance? I mean, it's just something you should want to do. Not only to help the passive income names, you should try to do your best at all times, shouldn't you? But again, year to date, we're up 19%. So we've been beating the market handily. All right. I hope you're seeing this. These numbers don't lie. You saw the income, you saw the performance. You see how we're using crafty ways to engineer our margin levels to stay low, and to engineer our performance just to stay relatively strong compared to the S&P and NASDAQ. So anyway, hope you enjoyed the video. Hope you learned some things. Stay tuned for further videos. Thank you.